Hi, everyone. It's Gerri Detweiler. I'm here with our first Facebook streamed webinar for NAV. Startup financing is our topic. So hopefully you see a slide there that says startup financing and not my Facebook feed. And if so, we're going to get started. So what I want to talk about today in this webinar is financing options for newer businesses. Now, startups can mean a variety of different things. And sometimes you'll see businesses with 250 employees that consider themselves a startup because they're in the technology space. That's not what we're talking about here. What we're talking about here is generally a business that is in the first 2 years of business. So you could be truly starting up right now, or you could be a business that is in the first year or two of business. And I'm sorry if that happened to you with COVID hitting. That adds to your challenges tremendously. But let's find out what's available and let's see how we can help you as you navigate trying to get your business going. Now, my contact information is up there. You're always welcome to reach out. I'll also give you some resources at the end from NAV, but this is very much an educational webinar. Just by way of background, real quick, I've been involved in credit and financing education for a long, long time. Way back in the day, I wrote the first mass market book that talked about FICO scores, and this is my more recent book, Finance Your Own Business, which talks about business credit and business financing. I've been with NAV for 5 years now, and I'll talk about a little bit about what NAV does. Some of you already know, but really our goal is to help you be successful in your business when it comes to the money and financing part of your business. And so I'll share some resources that we can offer you that will help you in that journey. So first I want to start with an overview of just what's going on, and then we'll get into some very specific types of lending that are out there. The lending landscape has changed dramatically this year. You know, we started the year just with so many different options. We talk about the 44 different types of financing out there for businesses, over 6,000 lenders nationwide, lending to small business, lots and lots of different products out there. And then March hit, the coronavirus shutdown started happening, and it was like the brakes on the freight train. Things just ground to a halt, and we saw a lot of lenders either halting, pulling back, some even cutting credit limits for existing customers. So it was quite, the change. So the government stepped in and they offered the Paycheck Protection Program and Economic Injury Disaster Loan programs. And then there were some states like in Florida where I live, they offered a bridge loan that ran out of money within weeks. So there are a variety of programs out there, and that's really where the focus shifted for a period of time. One bright spot that wasn't government related in that time was crowdfunding, and we'll talk about that a little bit in this presentation. But now we're moving into a post-PPP landscape. Right now, PPP applications are done. There may be another round in some way, shape, or form. We don't know yet for sure what's coming. EIDL, the Economic Injury Disaster Loan portal, is still open, but I haven't seen as much demand there because I think most businesses that wanted that kind of financing have already applied for that. So now at NAV, we're talking daily. Our team is talking daily to lenders about what's happening, what's going on, and they're coming back into the lending landscape. We're pretty excited with some of our partners that have started to lend again because we know that they fill a real need for many of our customers. And some of them are going to start with existing customers, renewing existing credit lines. Some of them are going to start with smaller amounts. Many of them are going to target by industry. We'll talk about that. What all this means to you, especially if you're a younger business, is that you've got to really really have to have the foundation built because financing startups always been challenging, but now there are additional challenges in this environment. So we want to walk through those and give you an idea of what might be out there. In terms of the most critical factors that I want you to focus on, I'm going to suggest that revenues, time in business, credit, and industry are probably the most key that we can talk about. Now, you're going to have challenges because you're a new business. So you don't have a lot of time in business, and maybe you don't have business credit. So we'll talk a little bit about that in this presentation. But just understand that if you are not strong in one area, then it helps to be strong in another. So if you don't have revenues yet, it helps to have strong credit, for example. So we'll give you some tips that fall under those under those qualifications. So revenues are becoming extremely important to lenders. What we've seen in the past few years with online lenders in particular is they like to link to your bank, your business bank account. So this is read-only. It's similar to the technology if you use a service like Mint or Personal Capital to keep on top of your personal finances, same kind of technology. And what it allows the lender to do is to view your revenues and see, are they coming from different sources, how often, how much are you making, etc. They want to see if you have low balance days, maybe days where there are bounce checks, and they'll have their own analysis for this. But you can expect this to be fairly common, especially with online lenders. And if you have a NAB account, which I will mention later, one pro tip is to go ahead and link your bank account. That's for read-only access. We aren't going to, take your money out of your bank account, but it's so that lenders who might be targeting you for financing offers, we have that information so we can present to you those options that might be a fit. So just make sure that you are prepared for that. And the best way to prepare for that is to have a business bank account. So even if you haven't really fully launched yet, let's say you've decided, maybe you lost your job, you decide I'm going to start a business. So go ahead at the earliest opportunity, open a business bank account. The sooner the better, because this is just like building business credit. Having this history is really important. If you have a little bit of money you can park in there, do so. If you don't understand, just do the best you can. There are no fee business checking accounts. We write about business checking accounts on the NAV blog. And so you could just start with a minimum balance and park it there so that you have a business bank account. And then going forward, you're going to run all your business transactions through that business bank account. You're going to try to keep a really clean line. We saw this a lot this year with PPP and EIDL, where business owners were contacting us and saying, well, the SBA is saying I can't get a EIDL loan unless I have a business bank account, or I use my business bank account to pay personal expenses. How do I separate that out? You don't want to be in that position. So the sooner that you can open a business bank account and really separate your business and personal finances, please, by all means do. Now, time in business is also important. So 2 years is, something of a magic number. We do find that more lending opportunities open up once you reach the 2-year mark. So for some of you, knowing when that time in business started, it can be confusing, because if you started a business, let's say you started as a side hustle, you didn't really incorporate your business, and you just started doing business in whatever way, shape, or form you did. It can be difficult to establish a start date. So here's a tip for you. Now, I'm going to recommend that you create a legal business structure, but if you haven't done that, you can do this as a sole proprietor. What you can do is you can file a fictitious name with your state. That's a doing business as. I'm in Florida, it costs $50 to do that. And basically you go on notice with the state saying, here's the name of my business. So doing business as. That's a good step. Getting a business license. And in many jurisdictions, these are required. So you don't want to overlook this step. You can get in trouble if you don't do it. Get a business license. That's another way. Best scenario is to incorporate, form an LLC, S Corp, or C Corp, because then you have a very clear date. The other step you can do is get your employer identification number. That's your EIN. It's free from the IRS. It's the business's version of the Social Security number. So that's another way. But whatever you do to start that date, write down that date and use it consistently whenever you apply for credit so that you have a clear start date. And I have talked to business owners over the years who started slowly. Maybe they started with just one client on the side, and they took these steps. So when they decided to go out full time, they had the year or 2 years under their belt, and they were in a much better position to get financing. So you really want to have that clear start date for your business. Now, credit scores are important, and I know that many of our NAV customers and many of the business owners I talk to want to get away from personal credit. I understand that and appreciate that, but I will mention that you start where you are. So you should know your personal credit scores. You should know where your credit stands. A business lender is entitled to check personal credit on any owner who owns 20% or more of the business. So you should be prepared for that. And if you are thinking about taking on a business partner in your business, you need to have a conversation where you both pull up your business credit and pull up your personal credit and you discuss it with one another, because you could be in a situation where a partner's bad credit makes it more difficult for you to get financing. Banks do not want you to try to hide a business partner. So anyone who owns 20% or more of the business should expect a personal credit check, maybe a soft check, which doesn't hurt your credit scores, but it's important to understand that. And then business credit is the other equation. So this is research, very new research by the Federal Reserve, their 2020 Small Business Credit Survey. And they asked business owners who applied for financing, did you use your business credit, your personal credit, or both to get financing? And if you can read what this says, it's saying 12% only used their business credit to get financing. 48% used both business and personal credit, and then 40% used personal credit. So at NAV, we think both are important, which is why we show both in both our free and paid NAV accounts. And I want you to make sure that you're checking both. If you don't know anything about business credit, I'm not going to go into that here. We do have some boot camp materials on the NAV page about building business credit, and we'll be happy to link to that so you can find that and understand steps for building business credit. All right, industry is going to be also very important. Certain industries are considered higher risk, and lenders may look at the risk of the industry when determining who they want to lend money to, or they might just preferentially decide to lend into certain industries and not to others for any variety of reasons. So I'll give you a quick story. One of our NAV customers was manufacturing signs for real estate agents. So, the signs that real estate agents put in the front lawn of a property they're trying to sell. And he was having trouble getting finance, discovered that his code, his industry code, was identifying his business as a real estate business and not a sign manufacturing, which are two different levels of risk. And real estate is considered a little bit more risky. So he had to get that fixed in order to get the financing he needed. So the older version of these codes are called SIC, or Standard Industrial Classification Codes. The newer versions are NAICS, or North American Industrial Classification System codes, NAICS codes. These are both something you can look up for free. They are codes created by the government for statistical tracking purposes, but they're often used by the industry to identify industries that they want to lend into. So you may find this information on your business credit report. Also, when you file your incorporation papers, you may need to identify your industry. We often find at NAV that this can be incorrect, as that customer story illustrated. So if you're checking your business credit and you do have a business credit report, you want to check this and make sure it's accurate, and if not, get it corrected. All right, now when most business owners think about getting financing, they think about going to the bank and getting a small business loan. And I do want to touch on that, but it's not going to be the main type of financing I talk about because it carries specific challenges. Top tier financing is financing you'll get from a bank, community bank, or a credit union. And it can consist of lines of credit, which is sort of like a credit card. They approve you for $100,000, you borrow what you need, you pay interest on what you borrowed, you pay it back, and you can go back to the well and get more money again. Term loans are fixed loans for a fixed amount of money. So lines of credit might be great for working capital, for example, or for seasonal needs, for inventory where it's a seasonal purchase, for example. A term loan is going to be a fixed amount of money for a fixed period of time. So this is, you need to acquire this equipment and you need this amount of money to do so. That would be an example of a term loan. So you borrow a specific amount of money, you have a specific repayment period, usually over anywhere from 2 to 25 years, depending on the loan terms. And then it could be a fixed or variable interest rate, but your payment's going to be pretty steady on it. Now, SBA loans really is not exactly a category of loans, but the SBA has several programs, actually quite a few, 8 or 9, that offer loans to small businesses for different needs. And the SBA, with the exception of disaster loans, including the economic injury disaster loan, they don't make loans. The SBA guarantees loans. So the Small Business Administration provides a guarantee to the lender who is approved to make the loan. And if the lender follows the SBA rules, then if the borrower defaults, they can collect on the guarantee. Now, the SBA sets the floor. They set the basic rules that the lender has to follow in order to collect on that guarantee, but the lender can add on additional qualifications. So An example would be that most SBA loans don't have a time in business requirement, but some lenders may. So you may find a lender wants the business to have been in business for 2 years, for example. So my biggest tip with SBA loans here is just to keep in mind that if you talk to one bank and they say, we can't help you, that doesn't necessarily mean you can't get an SBA loan. Now, if there's a very specific reason, I don't know, you're an undocumented immigrant, for example, then you wouldn't be qualified for an SBA loan, or you're in an industry that's prohibited by the SBA, then that would be a specific reason you can't. But very often I'll find that someone will say, I can't get an SBA loan, but they've only looked at one lender and they don't know what the universe is out there. And then, of course, commercial real estate loans, which can be very important loans for many businesses. That space is in a really tough spot right now due to the number of tenants who can't pay their rent, having trouble paying their rent. But that's also an important source of funding. Now, when it comes to getting this type of funding, lenders tend to want to see 2 to 3 years in business. So it is harder for startups to get this type of financing. It doesn't mean it never happens. I told a story in my book, Finance Your Own Business, about a startup here where I live in Florida that was able to go to a local community bank with a great business plan. They had some investors, they had some skin in the game, and they were able to get a loan to open. It's a business where you can go climb in the trees. The word is escaping, but basically it's an escape. It's like you can go climb their things in the trees and have a day out of adventure. And they were able to get funding from a bank, but banks aren't like the sharks on Shark Tank. They are not trying to look for the next hot thing. They are trying to lend money with a fair amount of certainty that they're going to get repaid. And so they're really looking for that opportunity to lend money and not take an unusual risk that would cost the bank money. They typically want to see strong credit. Banks are almost always going to check personal credit on the owners, and they're going to look at all owners again with 20% or more ownership. They're going to want to see financials. So expect, tax returns, business and personal tax returns. Often there's a personal financial statement required in addition to the business financials. You may need an up-to-date P&L, et cetera. And the other thing about these lenders is that they often want to make larger loans. So the compliance costs for them are pretty extensive. I saw an industry article that said the average bank has to pay about $6,000 or cover about $6,000 in compliance costs to underwrite a small business loan. Not sure if that's entirely accurate, but you can see that, if there's $6,000 going into underwriting this loan, making a loan for $20,000 isn't going to be very profitable for them unless they charge a really high interest rate, which most banks don't. So you may find, and I've seen this looking at some of the big banks and what they offer to small businesses, that their cutoff is a minimum of $150,000 or $250,000. And if you're looking for that amount, that's great. But if you're looking for a smaller amount, you might need to look at other options. Now, I did touch on SBA loans. I'm not going to go into great detail here, but we do have a free e-guide, and you can get that by going to score.org/NAV. SCORE is the National Free Business Mentoring Organization. We're a partner of the SCORE Foundation, and on that page at score.org/NAV, you'll see this SBA loan e-guide. And that will detail the different types of loans. There are loans for exporting. There are working capital loans. There are loans for real estate. If you want to purchase real estate, as long as it's 51% owner occupied. So there's a variety of programs out there. And as I mentioned earlier, the main thing to understand is it's not just one lender, except for disaster loans. There's a lot of different lenders offering them. And we do help to match borrowers to SBA loans at NAV. One more thing I'll mention is I pulled some SBA statistics this week and saw that in 2019, 17% of 7A loans, which is their most popular program, went to true startups, like opening a business startups. Another 19% went to businesses of 2 years or less in business. So there are startup SBA loans out there if you meet other qualifications. So don't rule this option out, even though it's going to be a little bit more work for you to secure this kind of financing for your business. And where can you get these types of loans? I mentioned banks, credit unions, Community Development Financial Institutions, CDFIs. These are organizations that are trying to help disadvantaged borrowers. So they might, for instance, work with women-owned business, veteran-owned businesses, minority-owned businesses, etc. There are over 1,100 CDFIs certified by the Department of Treasury in the US, but it's often very localized. So you have to do a little bit of homework to find the one that's right for you. And we are working on getting a list of those up on the NAV blog so that you'll be able to more easily find those in your area. And then finally, the NAV Marketplace. We will do our best to match you to financing offers, and I'll talk a little bit more about how that works shortly in the program. All right, let's talk about alternative financing. I'm going to give you a few financing options here. So I'm going to kind of go quickly through here, but you could always ask questions. And if I don't get to them during this live presentation, we'll make sure I get on Facebook and answer them for you. Vendor terms can be a very important form of financing. The Small Business Credit Survey I mentioned from the Fed said that 12% of businesses used this form of financing in the year, for the survey. So this book, Pancakes in Paris, is a very I thought it was a great read. True story of Craig Carlson, who started the first all-day American breakfast diner in Paris. And he went through all kinds of trials and tribulations, raised a whole bunch of money from friends, family, and strangers in the US, got over there. His business almost didn't come to life due to a variety of hurdles he ran into. But the thing that allowed him to open was the fact that his vendors, the companies that supplied the bacon and the eggs and the coffee and the wine, because you need wine at an all-day breakfast diner in Paris, they all allowed him to buy all that stuff on net 30 terms, which means he had 30 days to pay so he could get what he needed, cook the food, sell the meal, bring in the cash, and then pay the vendors. So this is a very essential form of financing for many businesses, and it can also help you build business credit. So you'll see a short link on the slide, nav.com/vendors, that leads to an article of vendors that are very easy to get credit with for the first time. They don't check personal credit, and they do report to business credit. So this could be a source for you to start establishing some business credit and also to get some credit for your business without a personal credit check. And they're often very startup friendly. Sometimes you'll find they may want you to make a few purchases before you get a credit line with them. Each one kind of differs, but it is a great way to get started with your business financing. All right, invoice factoring. So if your business will invoice customers and they pay later, this could be a form of financing for you. So I had my own business for 10 years. I did a lot of work with big financial institutions, and they expected me to pay my credit card or loan to them in 30 days, but then every 30 days, but then they sometimes take 3 or 4 months to pay me. And that's generally what you'll find is the bigger the client, the longer they can take to pay. So what this allows you to do is to get money for those invoices and get paid so you can continue to do the work. And it operates in a couple of different ways. There's invoice factoring and there's invoice receivables financing, where you're basically pledging the invoice as collateral. But either way, this could be a way to get your money more quickly. And it's very common in certain industries, fashion, construction, for example. And here they're mainly interested in the credit quality of the client who owes you money, the client who owes you the invoice, because that's who ultimately has to pay. They're less interested in the credit of the business. Sometimes they will check the personal credit of the owner. Sometimes they won't. Sometimes if they do check personal credit, it's usually a soft credit check. So you may want to look into that. And interestingly, they've gotten kind of creative. This is an example from one company, Bluevine, where they assign, you invoice in your name, the name of your business, but then they assign either a bank account or a mailbox that goes to them, so they can then take out their cut and forward you the rest of the money. And it avoids letting the client know that you're factoring the invoice, which some people find they feel like it's a sign that they're not doing business the right way. But I can tell you it's very, very common in certain types of industries. So it's not as big a deal as new entrepreneurs often think. All right, online lenders, this isn't a great category because online lenders can offer a variety of, they can offer a line of credit, they can offer a term loan, they can offer invoice financing, they can offer a merchant cash advance. There's a variety of different options that they can offer, and they vary in terms of the time and business required. A lot of times they'll be pretty upfront about it, but if not, if you have a NAV account and we have your time in business, then we know, which lenders are lending to businesses that are in the time of business in your, that fits your profile. So that's another way to get around it. Now, the one thing I would just warn you is that small business lending does not require the disclosure of an annual percentage rate or an interest rate. So it can be hard to figure out how much financing really costs. And sorry for the ugly slide here, but this is an example from PayPal where they have they show that they charge a fee, a fixed fee for this financing. What's the interest rate? Not sure. So I took their example, I plugged it into one of our calculators at NAV, which you can find just by going to nav.com/calculator. And it came up with an APR, if you see it there, of 25.6%. So one tip is if you don't see an interest rate expressed as an APR, you may want to use a calculator, and we have a number of those on the NAV website. As I mentioned, again, you don't need a NAV account to check these out, to translate it so you can compare the cost, because maybe that's fine. Maybe that's makes sense for your business and for what you're trying to accomplish with that funding. Or maybe you say, you know what, I've got a credit card that's at 0%. Maybe I'm going to use that for 12 months. Instead of that other financing. So it just helps you compare offers in a way that may be difficult if you're not using that kind of tool. Microloans are smaller loans. There's no set number. The SBA microloans go up to $50,000, but there are also non-SBA microloans that could go up to $250,000. Many of these are made by CDFIs. If you remember, I mentioned earlier, those are community development financial institutions, which could be nonprofit organizations. They're often trying to spur economic growth in a certain area or spur entrepreneurship for disadvantaged entrepreneurs. And so some of them can work with startups. Some of them are more flexible on credit qualifications, especially if you can explain what the issue was and you have a good explanation as to the problem. It can be a little bit harder to find them, though, because they are maybe local. They may not advertise. You may have to do a little bit of searching. So a couple of tips there is that your Small Business Development Center or SCORE chapter, SBDC or SCORE, may have information or tips on local microlenders that may be useful for you. And I'll mention one too when we get into the crowdfunding section. But this can be a good way to get started. And the SBA microloan program, by the way, the average loan amount is about $13,000, but it can go up to $50,000. All right, very popular for entrepreneurs to borrow or use their retirement funds to finance their business. So there's ways you can do that. You can just take the money out. If you're, depending on your retirement plan and your age, you may have to pay taxes and or a penalty on that withdrawal. So make sure you check with your accountant to understand the full cost. If you still have a 401k plan, maybe at work, maybe you're starting your business on the side, or your spouse is still working, for example, or your partner, and you can use that money, then a 401k loan may be an option. Those typically have to be repaid over 5 years. And then there's something called the Rollover Business Startup program, or ROBS program. And this is where you roll over retirement money into a dedicated account. You have to form a C Corp, and you have to use that to fund the business. Now, my co-author of Finance Your Own Business, small business attorney Garrett Sutton, does not like these plans. His concern is that the IRS guidance just isn't clear enough, and if you run afoul of it, then you could owe taxes and penalties. On the other hand, I talked to someone who works with a lot of franchises, and he said a lot of franchises use this successfully to purchase a franchise where they need that money up front, but they've got this turnkey business that they're going to start, and they feel confident in taking that risk. So just go into this with your eyes open, understand that there are risks if you decide to go that route, but there are times when it can make sense. And the other thing, of course, to keep in mind is that starting a business is risky, and we have many Americans who don't have enough retirement savings. So just, be very clear that you are taking additional risk with money that you might need for your retirement by funding that way. All right, let's talk quickly about crowdfunding. And there are 4 main types of crowdfunding. I can't really see the chat on Facebook, so go ahead and put your guesses in Facebook, and if we, I'll go like a correct answer after this to award you if you got the right answers. All right, let's go over the 4 main types of crowdfunding. The first is rewards, and that's like your Kickstarter. So that's where you offer a physical reward to your backers. So the picture you just saw on the previous slide, that was Cowboy Crickets. They're a veteran-owned business in Montana that has quickly, in I think 5 years, become the fastest growing farmers of food grade crickets in North America. So they make flavored cricket snacks and cricket flour and chocolate chirp cookies made with their cricket flour. So they were trying to introduce some new flavors of their snacks. I was one of the many backers of their campaign. They met their goal, and as a result, I got a bag of each of the new flavors, and they were delicious, by the way, and a chocolate chirp cookie. So it was a fun way to support the business, great way for them to get the word out, and a way for them to raise money. So don't rule this out especially if you have some kind of physical product or reward you can offer your audience. It could also be a gift certificate. Musicians use this, artists use this, so it doesn't necessarily have to be something like what they did. You can look on Kickstarter and see lots of different options to spark your creativity. But one interesting twist on this, I spoke to an entrepreneur a couple of years ago who said, I crowdfund all my new products. And he said, I don't need the money anymore. He said, but I want to test my marketing. He said, if I can't get enough interest, then I know that I need to go back to the table. So that's an interesting twist on crowdfunding. Debt-based crowdfunding is where you borrow money and you have to pay it back over time. And a great example of this is Kiva, KIVA.org. I alluded to them earlier. Kiva is a nonprofit lender. They make 0% loans to small businesses, no interest, no fees. The lenders are people who want to support small business owners. And so you can go on as a lender and we started with $25, choose a campaign to back. And then when that borrower pays it back, you can lend more money. So it's really a fun, engaging platform. And with COVID-19, they have expanded their offerings to up to $15,000 for businesses impacted by COVID-19 and a 6-month grace period on payments on those loans. So that's definitely something worth checking out. And then equity-based crowdfunding, this is where you're going to get investors into your business. And it's something that was signed into law when President Obama signed the Jobs Act 10 years ago. And it basically, there are platforms, equity crowdfunding platforms, where you can post your campaign and try to get people to invest in your business. This is the most expensive and time-consuming option, but you can raise up to $1.07 million on one of these platforms from investors. So if you need a larger amount of money, it's something I would definitely encourage you to check out and research. And interestingly, at least before the COVID crisis, this probably has changed, but before then, one fast growing segment was restaurants. A lot of restaurants were raising money on equity-based crowdfunding platforms. And then donor-based, you probably heard of. This is the GoFundMes of the world. I didn't typically suggest GoFundMe as a major source for small business financing, but they have really stepped up to the plate with the latest crisis. They've done a whole bunch of crowdfunding for small businesses impacted by COVID-19. Probably not as ideal for a brand new business if you're just trying to start, but it is a possibility. So don't hesitate to check it out and see whether it might be, worthwhile. The pro is time in business is of no consequence. It's really what can you sell? How can you entice people to back your campaign? So startups are perfectly fine. They generally don't check credit. Kiva checks credit to make sure I think you're not in active bankruptcy, but it's very flexible and they're very cost effective. But the key is really to have a good marketing campaign. And ideally, you want to have a way to reach people. So whether that's on social media, whether that's an email list. So as you're starting your business now, even if this is not of interest to you, I'm going to give you a tip. Make sure you have a way to stay in touch with your target audience, whether you have a physical location or an online business, social media platforms or email, whatever it may be. I'd probably spread it out a little bit. I think there's a lot of business owners kind of worried about what's going on with TikTok right now, but spread it out, but you want to be able to get in touch. So if you decide to go this route in the future, you have a way to reach your audience. And also keep in mind, reward-based and donor-based crowdfunding is taxable. Equity and debt, no, you won't have tax consequences when you take that money. All right, business credit cards. This is a very popular source of funding for startups. Most small business credit cards check the owner's personal credit score. They don't care how long you're in business. I've seen businesses start on day one and getting a business credit card on day two. Not all, that's not for all issuers, but many of them are very flexible in terms of time and business, but they will check the owner's personal credit score, but they often will accept income from all sources, not just the business. So if you still have a day job, or if your partner still has a day job and would step and pay the bills, if you couldn't, then you can list that on the application. It's also a great way to separate your business and personal finances. One thing we see popular at NAV is this is popular with fix and flip real estate investors. So they'll get business credit cards. They'll use that to buy what they need to fix up or rehab a property, and then they'll sell it, and then they'll pay off the credit cards and rinse and repeat. And some of these cards do not report to personal credit unless you default. So that can separate your activity of your business from your personal credit. There's a short link on the slide, nav.com report, that explains which ones do not report. Now, one thing I have to warn you is they are harder to get right now. So at NAV, we'll be monitoring this, and we will be staying on top of which issuers are coming back. Pre-COVID, we worked with all the major small business credit cards in our marketplace, and we still have relationships with them, but some of them have pulled back, and that will change. So, your NAV account will keep you on top of that. In addition, there's the Credit Card Act, which is a federal law that Obama also signed about 10 years ago. That law prevents things like double cycle billing and change your interest rate anytime for any reason. That does not apply to business credit cards. Now, most issuers voluntarily will do many things or adhere to many of those provisions in the Card Act voluntarily. But one thing they typically do is reserve the right to raise your interest rate if you're late. So on your consumer card, if you're late by a few days, they can't just hike your interest rate. There's rules around that. With a business credit card, if you're a day late, they could hike your interest rate, and that could apply to your existing balance. So you want to make sure that if you have a small business credit card, that you at least put that minimum payment on auto pay. So you want that minimum payment to get paid on time each month. That way you don't have to worry about a sudden interest rate hike. All right, friends and family, this is also one of the most popular types of financing for small business owners. They don't usually check your credit. They're very flexible, but we all know you can risk a relationship and seriously jeopardize a relationship this way. So, my best piece of advice there is that you really spell it out in writing, what the terms are, what happens if you can't make a payment, what are the expectations, and that getting a loan agreement may also help protect the lender, because if you default, they may be able to get a tax write-off. I'm not guaranteeing that. Talk to your accountant, but it may provide them with that option if the business is unable to repay the loan. The other thing that can do is you can also spell out, what their role is, so they aren't constantly giving you business advice that you may or may not want. Now, if you want it, great. But if you don't want it, it needs to be clear what the boundaries are there, and that can be very helpful. All right, today I got a question from someone who wants to start a business and wants to know where to get a startup small business grant. And I'm going to be honest with you, it is tough to get a grant to start a business. Contrary to what you have seen online, the government does not give out free money to start a business. Now, there is a very robust government grants program. And it could be worth your time, worth your while to spend some time on grants.gov, that government website, to see what kind of grants the government makes, because maybe that will give you some ideas for directions and a new source of business for the business that you want to start. So very worthwhile. But just getting a grant just to start a business is very uncommon. Most grants are to existing businesses to help them accomplish something. Now, that doesn't mean you should rule it out. Look locally. Again, contacting your local SCORE office or local small business development center. They may be able to alert you to grants in your community that might be available to young businesses or startups. Very often they don't require good credit. And my best tip is to really follow the instructions very carefully. We offer a quarterly $10,000 small business grant at NAV. It's very easy to apply, but you do have to be in business for 6 months. But it's very easy to apply. But for the first time, this last round, I was on the committee that helped to pick winners. And I was given a list of entrants and asked to, evaluate their application. It was just so clear, the ones who could articulate exactly how they were going to use the money. They were the ones that stood out. So you want to be able to clearly articulate to the grantor, whether it's the government or the private organization making the grant, how you plan to use this money to grow your business and to accomplish their goals. So maybe they're trying to create jobs in your community. How will you do that? How many jobs will you create, etc. Also keep in mind that small business grants are taxable. The IRS wants its share. All right, we're almost done. We're almost on the home stretch, and I'll be happy to take some questions. So personal loans. If you can't get a business loan, you may end up using personal funding. So the benefit is you don't have to have an established business to get a personal loan, because you're qualifying based on your personal credit and your personal income, again, from all sources. So there's no requirement that your business be making money. There's no requirement for your business time in business, no industry requirements, etc. But of course, anything you borrow personally, you're personally liable for, and it will affect your personal credit. So this could have an impact on your personal credit scores. Now, I will say that generally, when it comes to your personal credit scores, it depends on the credit scoring model that's being used, and there are a bunch of different ones out there. But generally, a personal loan, having a balance on a personal loan will have less impact than having a high balance on a credit card. With most credit scores, they look at your utilization, which is your credit limit on your credit cards compared to the balance that's reported. But that typically doesn't apply to a personal loan where you borrow, X amount of money for X period of time. So that's just a tip that may be helpful for you if you're weighing the options between a personal loan or a personal credit card to use for funding. I'm going to give you a couple more tips that I hope you'll find helpful before you borrow. The most difficult question for any business, really, when it comes to getting financing, in many cases, is how much do I need? If you have a very specific need, you're going to buy this piece of property or this piece of equipment, it's easy. But for many businesses, they might be looking at working capital. They might need some inventory. They might have a variety of different reasons why they need financing, and they have to figure out how much do I need. So really, there's a few ways you can go about this. One is to talk to your accountant and enlist their help in helping you figure out how you can use this money to accomplish your goals. You can also get free help, as I've mentioned before, through SCORE or the Small Business Development Centers, SBDCs. And to find those organizations, you go to SBA, which is the Small Business Administration, SBA.gov, not .com, .gov, SBA.gov /tools. And when you get to that page, you're going to see a link down on the lower right, if you're on desktop, that will say find local resources. So you type in your zip code and they're going to come up with the local offices that can help you. And they offer free mentoring. So they can help you figure out, okay, help you get a business plan, help you figure out how much capital you need to accomplish that business plan. How much do you need now? How much do you need later? But being as specific as possible is really helpful when you're going to get financing. The last thing you want to say to a banker is when he says, how much do you need? You say, as much as I can get. They don't like that answer. All right, and that ties into knowing your numbers. So I mentioned that I had my own business for 10 years, and despite the fact that I'm in the financial field, I hated doing bookkeeping, and I still don't love it at all. I do have a system, but I don't enjoy it at all. And it costs me. I mean, it costs me in terms of payments and invoices that took too long to collect. It cost me in terms of time trying to find receipts or figure out what that deposit or withdrawal was for, etc. The more you can set up the financials from the beginning, the better off you'll be. So those organizations I just mentioned a moment ago, they offer classes on how to set up your accounting software. We also have business resource partners at NAV for anything from accounting software to all the way to a service where they will assign a bookkeeper for you, and every month you send in your information, you get your books done. That's certainly a very viable option if you're not going to have the time or interest in really becoming an expert in that. So check out that and try to start it sooner, rather than later. Don't wait until taxes are due. We saw this so clearly with those recent COVID relief loans, where so many businesses, because they got an extension on their taxes, they hadn't done their bookkeeping, and then they couldn't apply because they didn't have the numbers they needed to apply, which come off their tax returns. So you don't want to be in that position. You want to be able to provide the information that a lender wants. And last point is, a lot of businesses worry about collateral. And in that Fed survey that I mentioned, about 38% of businesses said they did have collateral. But collateral isn't just heavy equipment, and it isn't just the building or whatever else it is that your business owns. Collateral could be in the form of invoice receive or accounts receivable. It could be in the form of all assets. There could be what's called a blanket UCC filing. What happens is when you pledge collateral for a business loan, the lender or the lessor, in the case of an equipment lease, for example, will file something called a UCC file, Uniform Commercial Code. This is through a courthouse, so it gets to the matter of the public record, and it basically alerts other creditors that they have an interest in your property, that they get first dibs on that property if you default. And so this is important because if you don't read the fine print, you may not realize what kind of collateral is being requested. And sometimes business owners will discover that the lender has taken a lot more collateral than the amount they've lent, and then they can't get additional financing. So once you start, for two tips. One is when you apply for credit, you want to read that contract, and if you don't understand it, get some help understanding it. And then number two is if you start building business credit, check your business credit report and see if this information is correct and up to date, because we find that lenders tend to be really good about placing UCC filings. They aren't always great about releasing them after the fact. So something you want to check and make sure is accurate. All right, let me give you a few resources that can help you in your journey. Now, first of all, you can get a free NAV account. Just go to nav.com, and it's completely free, will not require a credit card. And what we will do is we will, if you don't have a business already, we will give you tools to build business credit. If you do have a business, we'll let you claim that business, and we'll show your business credit summary reports from Dun & Bradstreet, Equifax, and Experian, three major business credit reporting agencies, and your personal credit from Experian. Now, the main goal of this, checking your credit, is very important. There's a lot of identity theft, and business identity theft is on the rise as well. But ultimately, the goal is to help you get financing. whether your business is young or established, and help you get on the path to getting better and better financing each go around. So we use our technology called Match Factor. We work with lenders all over the country, and we will present offers to you based on your profile. So the best thing you can do when you set up your NAV account is to fill it out completely. You know, link your bank account, tell us how long you've been in business, fill out those questions that we ask you, because then we can give you better matches. And we aren't going to sell your information to lenders so they can call you. We may call you and check in and see if you need help with getting financing, but you will not get calls from lenders, because we aren't going to sell that information to lenders as a lead generator. We're going to present you with the offers. And what we're going to do during this crisis is we are going to continually update that. And so if a new lender comes on board, or if a business credit card comes back, or if a lender comes back in the line of credit space and your business profile is a match, we're going to tell you that. So, you know, read the emails that we send you and the alerts we send you. We hope you find them helpful, but they're also going to alert you and check into your NAV account once a month to check on what's going on with building business credit, with your business credit profile, with your personal credit, and your matches. So as the lending environment is changing, and it's changing week by week, we want to help keep you up to date. Now, if you ever want to talk to someone about your lending needs, we do have a phone team who'd be happy to talk to you, no pressure. They'll be happy to help you understand what your options are and help you connect to those options. All right, and then we do offer paid plans for NAV accounts. So many of our customers use a free NAV account forever, and that's perfectly fine. We also have some paid plans, and our Business Boost plan and Business Manager, I hope I'm getting that right, don't want to get in trouble. Those two report to Dun & Bradstreet, Equifax, and Experian. So when you pay each month for that account automatically, it reports the business credit, so it adds a trade line. It can never be negative, because if you decide to downgrade to a free account again, we just don't report it again because you're not paid anymore. But what's been reported will still remain there. We just won't report going forward. So this is a popular feature with younger businesses that are trying to get a boost on, or a leg up on building business credit, because it can give them references very quickly on their credit report. And then I did mention our NAV Small Business Grant. If you've been in business for 6 months, you can apply for this grant. It's super easy to apply for. It's the most fun thing we do at NAV. Give it out every quarter. That's our most recent winners, Shea Butter Jones food truck in Atlanta. And we'd love to consider your business for that grant. And if you were paying attention, and when I talked about evaluating those applications, the more specific you can be about how you'll use that money to solve a business challenge or take your business to the next level, the more likely you are to make it into that final round of qualifications. So again, here's my contact information. I hope you found this helpful. I hope it gave you some ideas about, you know, different types of financing that might be out there. Again, if you're watching live and you have some questions, put it in there. If you have a really personal question, you can email me at that address. Or if you're watching later, we monitor our Facebook page all the time, and we'll be happy to answer those questions later. But we really want to empower you with the information and resources you need to finance your business now, as well as when it grows in the future. Thanks so much. Hope you found it helpful, and I look forward to hearing about your business success story.